Hey everybody, Smart Silver Stacker here. Hope you're doing well. It's time for a silver and a gold update. We're going to go over some data which suggests that the next move for these metals will be a breakout to the upside, and it appears that that move is approaching rapidly. So here, looking at the chart of silver, you can see that dating back to the April lows for the metal, when those reciprocal tariffs were announced on April 2nd, we had this big sell-off. Dating back to that, what we've seen is an uptrend off of those lows in which silver will consolidate for some time, weeks, months in some cases, and then break out to the upside. And so what we're in right now is the third consolidation of this uptrend. And this is really a critical one because we're butting up against resistance at the $40 level. This is a very significant level of resistance from a psychological standpoint. I think with silver, for now at least, any double-digit number ending in zero, so 40, 50, 60, these are all going to be significant zones of resistance. But that means that once we overcome them, we could see a lot of upside. And it's kind of a similar story in gold. Gold has been consolidating back to those April lows as well within this triangle. And you can see that the highs are getting lower and the lows are getting higher. So these two lines are converging. We are approaching a breakout to the upside and the next major move in this metals market. If you want to buy some gold or silver before that happens, make sure you check out sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. So this past week, we received some conflicting inflation data, which initially had a positive effect on the metals and the miners. We got this data last week that the consumer price index came in cooler than expected. So this is a positive thing for the metals typically, the idea being that lower inflation gives the Fed more free rein to cut rates and ease monetary policy, and more easy money is going to cause the price of the precious metals to get bid up. At least that's been the dynamic for some time now. Later in the week, though, we got the wholesale inflation data, the PPI data, what the Fed calls its preferred inflation gauge, and that was up significantly. That was up 0.9% in July. The expectations were only for a 0.2% gain. Now, given the nature of this beat, I think it's a very positive thing that we didn't see more of a correction, more of a sell-off in the metals. It's a testament to how strong this bull market in the metals is right now that they didn't sell off more on this extremely hot July inflation data. And if we look at the FedWatch tool from the CME, you can see that right now markets are factoring an 83.2% chance of a rate cut at the Federal Reserve FOMC meeting in September. Now that meeting is about a month away, so a lot can change between now and then, but there was some other data that we received which I think illustrates nicely why the Federal Reserve, regardless of what happens with inflation, is sooner rather than later going to be forced to ease monetary policy. Now, the first bit of data that we received was regarding tariff revenue for July. So this was a record high income from tariffs, $27.7 billion. Sounds great, right? The president was celebrating it. That sounds like a lot of money. Of course, it wasn't paid by foreigners. It was paid by anyone who was importing goods into the U.S., and they'll likely be passing some of those increased tax costs onto consumers. So that's going to have a positive effect on inflation. But nonetheless, money coming into the coffers is good. But hold up, don't celebrate yet, because we also got the monthly Treasury statement for July, which revealed that despite that bump in tariff income, the U.S. national deficit soared to $291 billion in the month of July because government spending is out of control. And that is ultimately the factor that is going to force the Federal Reserve to monetize large quantities of debt and ease monetary policy significantly more than markets are currently pricing in. And the more clear that becomes to markets as we approach the time when the Fed is forced to do that by a debt crisis or a financial crisis. I don't know exactly what the catalyst will be, but there's going to come a locking up of the system in which the Fed is going to need to print large quantities of money to enable this level of government spending to continue. And if they don't, the whole system's going to collapse. So that's one of the reasons why when I look at a major consolidation in the precious metals, I know there's a catalyst coming which is going to drive them to the upside, and it's going to involve a lot of money creation. Now, here's a chart that reveals something very interesting about the M2 money supply. So this is the amount of money in circulation, the amount of money in existence. And despite the fact that the Federal Reserve has been engaging in quantitative tightening, despite the fact that they have maintained somewhat elevated rates, right, higher than they were for some time, we actually saw this bottom out back in 2023. And since then, the M2 money supply has been growing again. And right now, it is at a record all-time high. So the M2 money supply is already increasing. Imagine what this chart is going to look like when the Fed is forced to return to easier monetary policy. It's probably going to look kind of like it did in 2020 when we saw the M2 money supply absolutely explode, and that kicked off a huge wave of inflation. And that's probably going to be a repeat event. You know, history doesn't repeat, but a lot of times it rhymes. So my forecast is we're going to get some kind of crisis. I don't know what it'll be. It'll be used to justify the printing of vast quantities of money, you know, and a lot of inflation, a lot of dollar debasement, something that normally wouldn't be tolerated, but they'll have some kind of a crisis like the, health crisis of 2020. I don't know if those words are still being censored on YouTube, but I'll err on the side of caution. But that was a huge smokescreen for the creation of trillions of dollars of currency pumped into existence. Well, get ready for a repeat of that. Now, here's another reason that the Federal Reserve is going to have to ease monetary policy one way or the other, regardless of what happens with inflation. This is the federal government current interest expenditures from the Federal Reserve Bank of St. Louis, which we recently got the Q2 data for 2025, $1.13 trillion, a new record all-time high interest cost on the U.S. national debt. And unless the Federal Reserve gets in there and buys up debt and cuts rates to reduce the interest cost of servicing the debt, this is going to become a huge problem. You can already see that the interest cost is going exponential, and eventually, sooner rather than later, this will become a self-sustaining financial crisis, because what will happen is interest cost will use up more and more of the government revenues. So unless they drastically cut spending, and there's not much chance of that, all that additional spending is going to have to come from more borrowing. And then that leads to more interest cost. And, I don't think I have to explain it to you. You're a smart audience. You can see how this can become a major problem in very short order. So the name of the game here is going to be more monetary debasement, and it means that gold and silver are going to be heading much higher, at least in dollar terms. Now, sometimes I'll hear people say things like, well, you don't want that to happen because if you see $100 silver and $5,000 gold or $10,000 gold, it just means that your dollar's been debased and there's a major economic crisis. That's true to some extent. However, I'm not looking at the economy with wishful thinking. I'm looking at it realistically and what I anticipate will happen. And I can tell you that, yeah, it's bad if silver is at $100 and gold is at $10,000 or whatever the final prices end up being. But it's a lot worse in that scenario if you don't own any gold or silver. So maybe don't prepare for the economy you hope to have or wish you had, but prepare for the economy you have. And it's bad. There's probably hard times ahead. That's what happens when you borrow $37 trillion and the whole world suddenly decides they want to de-dollarize. And on that note, I wanted to take a look at this Central Bank Gold Reserve Survey 2025. Now, this is from June, but this bears taking a look at. This is from the World Gold Council, and they had 73 responses from their contacts with central banks around the world for this survey. And two key highlights that I want to draw your attention to. The first is that respondents to this survey, who are contacts, again, at central banks, so insiders, overwhelmingly believe that global central bank gold reserves are going to increase over the next 12 months. We already know central banks have been buying gold at the fastest pace on record. That really began in earnest back in 2022 following the Russian invasion of Ukraine and the financial warfare that kicked off, and the trend has accelerated since then. Now, this year, a record 43% of the respondents to this survey believe that their own gold reserves will also increase over the same period. So the central banks in their countries. Interestingly, none of the respondents anticipate a decline in their gold reserves. So none of the central banks are anticipated to sell gold. Most of them plan on adding gold. They all believe that total central bank gold holdings are going to increase. And, I mentioned that in 2022, this trend kind of kicked off with the Russian invasion of Ukraine. And perhaps, hopefully, that conflict will be coming to an end soon. There has been the meeting between Putin and Trump, and there's a lot of speculation about maybe a peace deal being arrived at in the near future. However, even if that takes place, I don't think anybody can put the pieces back together. It's like Humpty Dumpty. Once he falls down and cracks into a bunch of pieces, you can't put him back together again. Well, the dollar's reputation, I think, has been sullied for some time by what happened to Russian financial assets following that conflict. People realize that if you hold all your assets in dollars, if for whatever reason you get on the wrong side of the U.S. politically, that you can be targeted and your access to markets can be cut off, your assets can be seized. And so in that kind of a scenario, what do you want to do? You want to buy euros? You want to buy yen? No, you want to buy gold, where nobody's going to have the ability to sanction you and cut you off from your assets. So this also highlights how things in the US financially are bad, but also globally, there's a lot of demand for hard assets like gold, and where gold goes, silver follows. More or less. Right now, the gold to silver ratio remains historically high. So, I'm focusing on stacking silver here, but I think gold is a fine thing to have as well. It's certainly a lot better than any fiat currencies. But leave me a comment down below to let me know what you think about gold and silver. Are we near to a breakout in gold, which is consolidating, in silver, which is consolidating here? And they both look like coiled springs to me, just waiting for that next catalyst to move them to the upside. But leave me a comment down below to let me know what you think. Thanks for watching, everybody. Don't forget to like, comment, and subscribe, and I will catch you next time. Smart Silver Stacker out.